Hello everyone, welcome to this conversation on non-bank finance. My name is Pierre Schlosser. I'm the Deputy Director of the Florence School of Banking and Finance here at the European University Institute. And it's a real pleasure to be today in the company of Thorsten Beck, Professor of Financial Stability at the UI and Director of the Florence School of Banking and Finance, and together with Mariana Barata, who is a Senior Research Associate at our school. Very grateful that we could find the time to have this chat. I'd like to start, Thorsten, with this question. There's been a lot of discussion in the past years, you will remember, about shadow banking, the more politically correct jargon then involved into non-bank financial intermediaries, into market-based finance, and now into non-bank finance. And according to some, if you ask people in the field, they would say that non-bank finance would cover hedge funds, insurance companies, money market funds, private equity lending, securitization. But Thorsten, what is your definition of non-bank finance?
Thanks, Pierre. Well, I think there are actually several definitions. So the first one, if you look at it purely legally, non-bank financial institutions are financial service providers without a banking license. I mean, that's the kind of legal definition I would give. The economic definition is these are institutions that undertake intermediation services, intermediation functions, but are outside the regulatory perimeter and do not take retail deposits from the general public. So that's kind of two definitions. Now, you mentioned already several types of NBFIs, as we like to call them as well. And there's a wide range. It's almost like a kitchen sink. No? You have the insurance companies, life, non-life. You have pension funds. You have other institutional investors, including investment funds. But then you also have the somewhat a little bit more obscure institutions, or one shouldn't say obscure, maybe less transparent, venture capital funds, equity funds, private credit, financial vehicles, special purpose vehicles. So it is a wide range of institutions, of intermediaries that offer bank-like services but are not regulated like banks. Often they are subject to other types of regulation. I mean, insurance companies are subject to regulation and supervision. Sometimes they're not really properly supervised or regulated, or they're just mentioned somewhere in the legislation. And of course, as well, there are new types of these institutions popping up all the time. Now, finally, since you also mentioned market-based, one can also take a little bit of a different view on non-bank finance, and that's more like an activity-based. Linkages between institutional markets. Think about securitization, for example. Clearing and payment services, the underlying infrastructure for this. So there's also this kind of broader view of banks being kind of these institutions sitting there, taking deposits and lending, and basically everything else that happens is linked to banks, but partly outside, goes through markets, be they public markets, be they private markets. That's kind of referred to as non-bank finance.
So would you say that despite the evolution of the term from shadow banking to non-banking financial intermediation, the world today can still be divided in two buckets, banking and a non-banking bucket?
Yes and no. So on the one hand, yes. I mean, one can basically do the counting game, right? So who's a bank and who's a non-bank, can look at the assets, the balance sheets, on the one hand. On the other hand, these two segments, banks and non-banks, are really closely intertwined with each other. I mean, to give a couple of examples, most investment funds in Europe are actually owned by banks. So there you have direct ownership link. You also, in the US, you have a lot of funding from the banks to the NBFI sectors. And funding sometimes not just from banks to one type of NBFI, but to one NBFI and then yet to another NBFI. So they're closely linked, these two segments. And this also means that we can't really treat them as independent players. But they interact with each other. If there's a shock, if there's fragility in one of these segments, it will easily go back into the other segment. I mean, for example, Dash for Cash in 2020, at the beginning of the pandemic. Yes, lots of corporations drew down credit lines from the banks, but not only corporations, non-financial corporations, but also non-bank financial intermediaries drew down credit lines they had from the banks. I mean, that's why you directly see the linkage between the two. A second example is the gilt crisis in fall 2022. Sorry, the gilt crisis in 22 in the UK. Lots of pension funds had hedged their interest rate positions, but it was the move in the interest rate was much more than you would typically hedge for, which means they received additional margin calls, and these margin calls ultimately could be fulfilled only with lending from borrowing by pension funds from the banking sector. So you can see these two segments are really linked. So yes, on paper you can divide the world into non-banks and banks. In realities, these two segments are closely intertwined with each other.
And they're also closely regulated, because before perhaps there would be a wider difference between the regulation of the banking sector and everything else, and maybe that gap is being addressed in terms of regulatory perimeter.
Yes and no. I mean, after the global financial crisis, there has been a closer regulation also of non-banks, for example, money market funds. But it's a bit like when you kind of start regulating, when you extend the regulatory parameter, what you often get as reaction is, on the one hand, you could think about new intermediaries, new institutions popping out just outside the regulatory parameter. Or I think, which might be the better view, is that certain activities undertaken by banks are being pushed by the banks themselves outside the regulatory entities, outside the regulatory parameter, through new kind of vehicles, through new kind of non-bank intermediaries or structures, entities. And it's a bit like a cat and mouse game. So, I mean, you can see the regulator as a cat constantly chasing and making sure that the house stays clean, and the mouse is just keeps going into somewhere else, into new holes, and just escaping. So I think that's maybe a way to look at it.
So you've mentioned the arrival of new players into the financial world, and I'm wondering, how do you see the involvement over the last 10 years of the non-banking space? Roughly speaking, I don't know if you have some numbers on how is the size of the EU current market on this.
So in the EU right now, in 23, I think that's the latest numbers that we have, it's now the investment funds, other financial institutions, so the whole NBFI segment is about 42 trillion euro. And it makes up about 40% of the overall financial system. So it is a pretty big chunk. The EU is actually still a little bit behind other parts of the world. I think overall, globally, the non-bank financial intermediation segment has now about 50%. Now, in the EU, there has been a catch-up. So it really, in both in absolute and in relative terms, this segment of non-banks has tripled over the last 16 years, so since 2007, right before the global financial crisis.
You mentioned, Thorsten, the word segment several times. If you were to pick the most dynamic segment of, let's say, capital markets development overall, among the following, which one would you pick? So private credit by private equity, securitization, money market funds, and crypto.
Okay, let's go one by one. So private credit, I think it is probably the most dynamic one in terms of growth. It has grown a lot, again, partly as a reaction to the regulatory constraints on the banking side, but also in a positive sense that there are alternative sources of funding available for enterprises. So I think that I would probably call it the most dynamic segment. And again, it is linked back to the banking sector because, again, lots of funding for private credit comes ultimately from the banks, being leveraged in the form of these private credit institutions. In terms of securitization, I think that is also, again, an activity that is becoming more dynamic, which has been kind of pushed back a little bit after the global financial crisis because lots of people saw the problem, one of the core problems of the fragility in securitization. But with proper regulation, I think this is probably has a certain return. Money market funds, I think this is special in the EU for the reason that a lot of the resources, but also the assets, both funding and the use of the funds, is actually outside the EU. So it's a bit of a critical issue for the EU to have so much money coming in, then being also going out again. And again, it could be not necessarily linked to the bank system directly, but through portfolio reshuffling, reallocation, that there could a certain risk arise. Finally, crypto. I mean, I've been a skeptic of crypto for years. I mean, I still think it's the tulip mania of the 21st century. It is, I mean, in size, it's now 1.6 trillion globally. I mean, that's compared to the overall NBFI market, relatively small. It is currently actually not very much linked to the traditional financial system, including to the banking system, but this is on the good news. Of course, on the news of challenges going forward, there are now these so-called exchange-traded funds, ETFs, linked to the crypto world, and that ultimately could bring in volatility also into the banking sector. So I would, it's a space. I mean, if you want to call it dynamic, I wouldn't call it dynamic in a positive sense, but then it's a space to be watched. Again, I don't quite see yet major risks and challenges arising, but something to be watched.
Yes, so you're saying that crypto is definitely a space to watch, and that leads me, I think, also to discussing about risks in the first place. So why, according to you, Thorsten, is that NBFI considered to be risky in the first place, and why is it a problem for Europe?
Well, in the first instance, you could say it is as risky as banking, and we see also certain risks now in banking. I mean, we see leverage issue, we see liquidity mismatches, we see possible shocks coming through asset price adjustments in the markets, for example. On the other hand, it's actually also even riskier than banks, because leverage is often even higher in non-bank than in banks. Again, because of the lack of adequate regulation. You could also argue it's riskier because of the linkages between non-banks and banks, and because of the limited data that we have on measuring these exposures and clearly identifying the different linkages. So I think that's why I would say non-banks are at least as risky as banks. They might be even riskier. The main problem I would see is when we get to a situation, which we now in several instances got to, where what is called the financial safety net, meaning the backstop provided by central banks, by the government, has to be extended from banks to non-banks. As we've seen it with money market funds in the US in 2008, as we actually saw it also even with pension funds in the UK in 2022. So I think that's where this risk basically ultimately crystallizes and materializes.
So Thorsten, you've mentioned that the banking and the non-banking worlds are intertwined. And you also mentioned that crypto for now is not a big problem for the banking sector. But how are European banks exposed to NBFI, globally speaking? Is this something that we should not only watch but be concerned about?
Yes, I think we should be concerned about. I mean, so again, one, in Europe specifically, lots of investment funds are being owned by banks. So there's a direct exposure. But there's also an indirect exposure, and that's somewhat parallel to why we think about exposures between banks. I mean, so you have what is called the common asset exposure, right? So different banks being exposed to the same type of assets. One bank has to fire sell certain assets, which depresses the price and therefore then also negatively affects the balance sheets of other banks. And similarly, you can see if there is a non-bank that has to do a fire sale of a certain asset, this has a negative impact on other non-banks and ultimately also back on the banking sector. So this is one important linkage between the banks and the non-banks. There are also then more direct exposure links. For example, through credit exposures of banks to non-banks, for example. So there's, again, it's similar to banks being exposed to each other. In the case of non-banks, additional exposures come in. Again, we might not have necessarily the right data to actually observe properly and monitor these exposures. So that's one of the main problems.
So speaking of monitoring, earlier this year in January, the European Commission published a report about the review of the macro-prudential policy framework, and it had a chapter or a big emphasis also on NBFI. Having read the conclusions, do you think the Commission got it right, and do you have something to add to what has been included in the report?
Yeah, so I think the report rightly pointed out that there should be a focus of macro-pru beyond banks, also more to the non-bank financial intermediation sector, and that also there is a discussion to be had about potential macro-prudential tools in the segment. Now, you could say, well, we haven't even gotten to the point where there's a consistent set of macro-prudential rules or tools and policies for the banking sector across the EU. I mean, apart we have the capital buffers, but we don't, for example, borrower-based measures are not even available in all jurisdictions, and they are definitely not being applied in a consistent way. But I think given the importance and the increase in the importance of NBFI, yes, I think the focus is correct that we need more both monitoring, but then also a discussion on what kind of tools can we actually use in macro-prudential toolkit for these non-bank financial institutions, which, by the way, also of course reflects what the European Systemic Risk Board was ultimately created for. It's not supposed to focus exclusively on the banking sector. It is also supposed to focus on the overall financial sector, including insurance and the security market. So I think it really matches also with both the kind of the function of the European Systemic Risk Board, which is the macro-prudential authority in the European Union, but also reflecting in the increasing importance of non-bank in the financial system in Europe.
Staying in Brussels, but maybe with a bit more distance to our conversation right now. So if you take a step back, Europe has been trying over the last almost 30 years now to make its economy less dependent on banks and more on capital markets. And there are discussions, as we know, also at ministerial level right now to revive capital markets. But is this a good objective in the first place? Also, is it a realistic objective?
Well, I'm glad, Pierre, that you actually kind of we're switching a little bit from risk to also opportunities. And is the good goal? Yes. Is it realistic? Well, let's come to this later. But yes, I think, I mean, lots of observers have pointed out that the financial system in Europe at least used to be heavily bank-based, if not bank-biased. And I think there is something to be said about diverse financial systems. I mean, just to give you a couple of arguments, banks like to lend to enterprises with collateral and with a track record. So they're not in the ideal position, for example, to lend to startups or to firms that rely more on intangible assets, such as in the IT sector, for example, or also maybe in the kind of more green innovation sector. So I think just for that reason, it is good to have also alternative providers of financial services in the financial system. So I think the objective is definitely a very good one, to diversify the financial system. Now, when people discuss capital market union, they often think about stock exchanges, bond markets, but I think it's much broader, and this ultimately gets us back to the discussion we started out with. It is really about strengthening the non-bank financial intermediate sector in the sense of both private and public. Yes, stock exchanges, bond markets, but also about private capital markets. Again, venture capital, equity funds, which can help support the startups and novel enterprises, and ultimately help us in the transition to a net zero economy. So I think it is a very crucial objective to undertake that. Is it realistic? Yes and no. I mean, I think it's indispensable that we ultimately move there, but things have been going crucially slow in Brussels or elsewhere. And the reason being that capital markets, also non-banks more generally, rely even more than banks on scale and networks externalities. So the bigger, typically, the better. I mean, we can even see this within Europe's, the stock exchanges of Paris is more liquid than the one in Brussels, for example. So kind of combining forces to get to a truly European capital market, both public, but then again also private. I mean, again, venture capitalist equity funds rely on being able to invest across the borders in as large a market as possible. I think that is really, really critical. And I think a big push has to be made to ultimately get there. Now, having all of this said there, so there's a big opportunity, there's a big a task to be had in building up non-banks. Of course, coming back to the earlier part of our discussions, there will also be new risks popping up. So it's not saying we just should let 1,000 flowers bloom, but we have to carefully actually watch them bloom and see that no new risks sources are developing, or at least are not developing in a very kind of rapid and uncontrollable way.
So perhaps staying on the risks dimension, and also as a way of concluding today's conversation, you mentioned that we don't have yet a truly European capital markets, not union, but also not the market itself. But we also lack a truly European capital market supervisor. Will that pose a problem and potentially constitute a systemic risk for Europe? And in a way, could it also be interpreted as an obstacle to progress at these ministerial conversations to establish finally the Capital Markets Union?
Yes, actually, I would put a stronger focus on the last point rather than on the first point. So yes, a stronger supervisor for security markets can also help with risk, although we often, of course, also see kind of more the consumer protection as an important part in this part of the financial system. And yes, if it were stronger, then it could also help in this context. I see it actually as more important to create a true champion for the capital market union. And I think they are a true European supervisor that focuses on the development of a pan-European securities market, or non-bank segment if you want so, can be truly helpful to push this agenda forward.
Fantastic. Well, unfortunately, this conversation is coming to a close. We hope that you enjoyed it and that it provided you also with a few new, fresh perspectives to chew on. We'll be back soon. In the meantime, have a great rest of the day. And I'd like to thank Thorsten and Maria again for this moment together.
Thank you.
Thank you, Pierre, as well.